Hello, everyone. This is Sebastian McMahon from IA Financial Group, and here's an Economy and Finance 101 video on foreign investing and currency management. So it's a question we've been asked many times through the years. Can you explain in simple terms why the movements in the Canadian dollar have such an impact on the value of foreign investments? So here, a picture worth, I think, 1,000 words. So if we start on the left-hand side of this slide here. If the Canadian dollar is getting weaker and weaker, that is a tailwind. So that's a positive for the value of your foreign investments. So the value of foreign assets rise. And on the opposite, if the Canadian dollar becomes stronger and stronger, that's a headwind for the value of your foreign assets. So the value of foreign assets would fall then. So it might seem counterintuitive, but when we move to the right-hand side of this page, top right, you see that when it's the time to purchase and foreign assets. At the moment of the transaction, what you do is that you take some Canadian dollars that you have, you sell them to get some foreign currency. Here in this example, you buy some US dollars. So sell the Canadian dollar, buy the US dollar, and with these US dollars, you will buy the foreign asset that you're looking for. That's when you buy. When you want to sell, or when we are evaluating the value of your portfolio, so what would be its worth today if we decided to liquidate the positions, then it's the opposite that happens. So when you're selling your foreign assets, you're selling that on the market, selling the asset, you get some US dollars in this example, and then you need to convert these US dollars into Canadian dollars to bring that into your bank account. So you're selling the US dollar, buying the Canadian dollar. So if the Canadian dollar becomes stronger and stronger, you can buy less and less Canadian dollars with every US dollar that you got from selling the asset. And the opposite is true. If the Canadian dollar has been weakening during the time that you were holding the position, then you can have more Canadian dollars per US dollar that you got from selling your asset. So that's how it works. So looking maybe at a few examples here. So appreciating Canadian dollar between April 2020 and April 2021, the Canadian dollar was very strong, up 13% over the year. And if you look on the right-hand side, if you decided to hedge your position so that you didn't want to have any impact from the movements of the Canadian dollar, then you would have been better off by about the 12% more returns than if you decided to not hedge your position for movements in the Canadian dollar. On the opposite side of that, if you have a depreciating Canadian dollar, here an example from April 2014 to April 2016, Canadian dollar depreciated by 15%. So if you decided to hedge your position, if you bought the S&P 500, then you pretty much went sideways. You ended up with about 10% return, but I mean going sideways most of that period. But if you decided to not hedge that position, then you would have been 18% higher in the value of your foreign investment as a result. So again, just to put it simply, when you buy a foreign asset, you need to sell the Canadian dollar, and when you sell your foreign asset, you need to buy back the Canadian dollars. So if the Canadian dollar goes up in value, that means that you have less for every US dollar that you have, and the opposite is true. So it's as simple as that. So I hope here these few charts help to make this thing simpler. So thank you. See you in the next Economy and Finance 101.